To be honest, I think the single biggest thing is how the radical change in how founders are building their companies with.
Really excited for today's conversation with my friend Peter Walker. Peter is head of insights at Carta, and we're doing this interview from Carta's headquarters in downtown San Francisco, a short walk from my office. Peter just published his State of Startups in 2024 as one of his marquee reports. It's a 110 plus page deck on the most important trends in venture. As a fintech investor who leads round to the pre-seed and seed, I feel like Peter's work is required reading, not just for what it covers in fintech, but for what it covers across the entire venture ecosystem. Venture used to be this really opaque asset class where it's hard to find good insights. Carta, because they connect to 40,000 companies' cap tables, has an amazing data set to draw from. Today, we're going to talk about the state of startups in 2024. We're going to talk about how much money was raised, what sectors are hot, what cities are raking in the most capital, whether startups are hiring or firing. We're also going to talk about why some venture funds are losing money, and a lot more. It's going to be a great conversation, so I'm really excited to dive in. Well, Peter, thanks so much for having us in your office here. I'm excited for this conversation.
Absolutely, Rex. Thanks for coming.
I think 2024 is a really interesting year, and 2025 is going to be even more interesting because there are good things, there are bad things, and there are mixed things. And so we're going to cover all of that. Why don't we just start off with funding and where funding went in 2024?
Definitely. So I think it's important to note, we're talking about a big deck of data here that we put together from the 40,000 or so startups that use Carta as their cap table. 2024, in a nutshell, was slightly better in a lot of metrics than 23. So total funding on Carta was something like 85 billion or so, up from 75 the year before. That's not a massive jump, but at least it's not declining anymore. But we're still nowhere.
We had a period of free fall.
Yeah,
out of the free fall
totally
in 2022.
Rough. We're not even close to where we were in the frenzied time of 2022 or 2021, excuse me. Yeah. But I'm not even sure that would be, we're all kind of dealing with that hangover anyways. I don't know if it'd be healthy to try to get back to that level of funding immediately.
Yeah.
But to your point, in terms of good, bad, and mixed, I think for a lot of founders, it feels worse than that. And if you're in AI, it feels kind of frenzied again. So depending on what kind of vantage point you have on venture, the feeling is very different.
Yeah, and we're going to dive into sectors like AI. We're also going to dive into activity at the stage level, seed versus A versus B versus IPO. And actually, speaking of IPOs, let's go there because this is one of the other big stories that was a non-story in 2024. Yeah. Is maybe a story in 2025, which is the IPO.
Knock on wood, man. We need them back. I mean, we've had, this chart from Cotu says we've had 14 in the last 3 years.
Yeah.
That's just not enough. No matter how many M&A transactions there are, or even increased secondary activity, the only way you really get true recycling of capital is through IPOs.
Absolutely.
So if people are looking for what's the one metric that you should track to see what's the health of venture overall, IPOs is maybe a lagging indicator, but it's a pretty good one.
Yeah, and it's crucial because you get the distributions, DPI, and the whole recycling gets the ecosystem going. Unfortunately, we're not going to be able to answer how many IPOs we're going to have because Carta does not have that data.
We don't.
Can't see in the future.
We do not.
But you have the next best thing, which you can see a lot of the activity late stage that's happening that might be indicating liquidity is coming back in.
Definitely.
But we said we were going to talk about sectors as well. So why don't you tell us about one of the hottest sectors, which unless you've been living under a rock, even if you're under a rock, I don't know how you would have missed this, but what's going on with AI funding?
AI-powered rocks. It's the next VC-backed ecosystem.
It could get funded.
In this market, at least in Silicon Valley, for sure. Look, AI has been the story effectively since mid-2022, right? And 2024 was no different. We saw the percentage of capital going to AI companies across every stage was increased. I think one of the interesting points is that, most of the time a technological shift like this, you would kind of see it start at the early stage and then creep slowly into Series D, Series E, et cetera. AI, because it's been adopted so widely by even already big companies, I kind of think it's already flowing across all of these stages. So something like half of every dollar invested into pre-IPO companies on Carta was to an AI company this year. Yeah. And I mean, you tell me, but I don't really expect that to change in 25.
No, I mean, it's crazy. You can look at all the way in public markets, NVIDIA's market cap exploding along with the other Mag 7. And then you can drill all the way down to pre-seed and seed, and you can see people scaling to higher levels of revenue faster. And some of them are being bootstrapped and being more capital efficient than ever, which that's going to be a really exciting thing we're going to touch on a little bit more later.
Absolutely. And the other point on the AI, and this is maybe a question for the investors listening in is like the definition, what is an AI company? Is this, it's probably the question I was asked most last year. And I don't have a good definition for it, but the way we have categorized it in our data was we asked the founder, are you an AI company?
Yep.
And so are some of those founders playing fast and loose with that terminology? I'm sure, but based on the way the valuations work and all that kind of stuff, it kind of seems like investors agree with most of those definitions.
Yeah. I think one of the interesting things about 2025 is it's going to be a year where the AI rubber meets the road. Right now, we're talking about like foundational models, but it actually has to be applied to certain sectors. And so just in the same way that everyone is obviously a compute company, everyone is obviously building the cloud, everyone is obviously building AI, it's almost lost meaning, but we're going to start to see it applied in certain sectors. And that's going to be, and so maybe it's going back to fintech and healthcare, and we can talk about those sectors
maybe it's the thing that in 26, we'll just kind of stop talking about AI because it's assumed, right? And you're just like, you're building with the latest tech.
And you're just applying it in these sectors of the economy, which is going to be super exciting. But let's dive into the activity by the stages, both across super early and growth. And I think we have some data here on like the number of rounds, growth stage, that sort of stuff.
Absolutely. I think that this is actually a really interesting point, which is like, what makes venture, the like atmosphere around venture? How do you feel if you're a startup founder or an investor? You can look at a total that says more capital was invested last year than in 23. That's easy. But given that a lot of that capital went to these massive AI rounds, it can also feel, because the round count didn't raise nearly as much as the capital did, it can feel like things are sluggish, except for the lucky few who are raising crazy amounts of money. And I think if you look at this by stage, 24 was actually a better year for late stage, or at least of more growth in late stage than in early stage. Whereas safes and notes, like the pre-seed kind of thing, or even early stage seed and Series A, kind of trundled along last year. It wasn't like some giant boom.
And I think what's happened there, and I do mostly pre-seed and seed investing, is it's, it fluctuates like 10% a year, but that's not crazy. That's not being whipsawed. It's just a steady state of company formation, which people don't appreciate because you might hear the dollars down. It's just people are raising less money. Part of that is because you don't need as much money. But then you get in I think the middle is where there's a lot of pain because these graduation rates are stretching out. Founders aren't necessarily hitting the growth numbers they want, or they don't want to sell equity at the price that new people want to buy it. And we can see some of that in like the down rounds and other data we're going to get into.
Absolutely.
I think this chart is a great way though, too, of articulating a lot of the collapse in activity maybe isn't a collapse.
For sure. Just remove 2021 from our collective memories and hey, everyone feels a little bit better, right? It's so easy to compare today to the most recent peak, as opposed to looking over the long trend of history, which is gradually the amount of capital into venture capital has risen. Ups and downs year over year, you might have a different story, but 21 was this sugar rush of fundraising that we are still sort of dealing with at the moment.
And this is total cash raised by companies. The one thing it doesn't speak to is total cash raised by venture firms. It also spiked in 2021. So that capital actually needs to start coming back into the market. And 3 years after you raise, you kind of got to get ready to start deploying.
The dry powder debate, right? Where there's all of these TechCrunch headlines about X hundreds of billions of dry powder waiting. If I'm a founder, I'm not sort of predicating my raise on, hey, I think the dry powder must be released in this 6-month period, but it does need to get deployed at some point.
And when you look at a chart like this, you can see it's not been deployed, and certain stages are down a lot more than others.
I think there is the latest stage. So the closer you were to IPO, the more of a whipsaw it was, because probably you took on capital at the peak of the market at pretty crazy valuations. And so as the IPO window is shut and nobody's paying up at that same dollar rate anymore, you have to turn around and say, okay, what about my operations can I change? How do I make this business last longer than I thought it was going to need to?
And there's the saying that usually private markets lag public, but then later stage digest that information the most quickly. And so now actually public markets are looking better. We talked about maybe this is a year for more IPOs, but we're still not seeing a ton of activity. And historically, last couple of years, like you can see in the time between rounds that you've put together.
The time between rounds is really, you can look at it from either the investor or the founder viewpoint. Obviously, from a founder, if you were planning on fundraising every 18 months and it's going to take you 30 months instead, that's a huge difference. And you're going to need to make that dollar last a lot longer. But some of this is probably founders choosing not to fundraise, right? Either they've gotten pretty close to profitability, they don't need to, or they're saying, we raised a big round and we can make it last longer than we thought and it's okay, right? So some of this is founder preference. I think a lot of it is investors have been a little bit more reticent to like bet on those growth rounds.
Yeah. So yeah, some of them are growing and don't necessarily need to raise. Others have cash and don't want to raise at a price that they don't like. So there's a whole bunch of reasons why it's slowed down, but maybe it'll start to change. But it does mean, which we talked about earlier, liquidity and distributions and exits are slower.
At a premium. But this chart, which shows just how old companies are as they hit these various funding milestones, I think is quietly one of the more important charts to sort of digest if you're in private markets, which is if the life cycle of a startup is no longer 8 to 10 years, but instead it's 13, 14, 15 years before they're going to go public. Yeah. That changes everything about being a venture investor. That changes everything about being a founder. Like the whole ecosystem is 50% longer. And that's like, it's a big deal. You know, it changes all the underlying assumptions.
Yeah. And I think about this as someone who raises funds and they're generally 10-year funds. And that's true of pretty much everyone in venture. Well, if companies are staying private longer than 10 years, you need to think about exiting.
Have you like had conversations with LPs where they want to talk about that 10-year lifetime?
This is a whole evolving area. I think historically, venture investors were just buyers.
Yep.
And they didn't really think about exit because you couldn't necessarily control exit that much in that exit was basically a big strategic M&A activity or it was going public, an IPO.
Yep.
What's changed, and part of the reason is a structural reason. Most venture capital firms operate under the Securities Acts of 1940 or the venture capital exclusion. So there's a regulatory definition of what makes you a venture capital firm.
Yep.
And you can't buy secondaries. You can buy shares primarily or primary shares directly from the company, but you can't buy them from employees or you get in trouble and you become a different kind of fund. That fund is an RIA. Now all the big players are RIAs. So now a lot of early stage investors like myself, you're gonna have to think about being both a buyer and a seller. And that's weird, right? Because venture investors have always been like, hold on to your winners, but you have this 10-year reality for fun. So that's a longer conversation. Let's not get distracted.
Sounds like a different podcast.
Let's not get distracted talking about this. But one of the ways that this lack of liquidity is showing up or lack of primary rounds is bridge rounds. So talk to us about what's happening with bridge rounds for some of the later stage companies.
So this is, I think, the emblematic sign of an ecosystem that is struggling to figure out what is the right valuations for these stages, which is a lot of companies going back to their prior investors and going, look, we tried to get to Series A. We didn't quite have the metrics, or the metrics moved underneath us, right? And so we just need more cash. Like, will you, current investors, put up a little bit more cash for more equity and do this? And we saw really big spikes in 23 of the percentage of all rounds in a stage that were bridge rounds. Coming down a little bit in 24, which is good. That's healthy. Seed is its own kind of thing. I think actually seed bridges are either really good or really bad. Either a company is missing everything and needs more cash, or the seed investors are so excited that they want to get in even more before the A. And I see both of those kinds of things happening.
And it depends on how much you're like. You raised a $500K pre-seed and you need more money. Like, that's not surprising. Like you raise a small amount of capital, but I think the more painful and harder spots are usually at like the B and the C, which that peaked in 2023, which makes sense. You probably raised in 2021, but the market hasn't really come back. And now it's come down a little bit.
The other point on this bridge round, it's actually not shown in this chart, is there are a lot more people these days that are raising bridges using safes or convertible notes instead of priced equity, even though they've already raised some priced equity. I honestly feel...
Is this a priced equity only
This is
chart?
a priced equity only chart, which is
interesting.
interesting.
Okay.
So, and I candidly feel a little queasy about that, especially on the convertible instruments. I feel like sometimes they're used for bridging because they seem easier or simpler, but they actually just kick the can down the road of hard questions, and they can lead to tricky stuff down the road. So I don't love that approach.
And often there aren't great choices for kind of structural reasons that are frustrating. So people do do that. And then this relates to down rounds generally, which are kind of related to bridge rounds.
I mean, this chart is interesting in that it's almost like we just took the down rounds that should have been happening in 21 and just waited. And now, boom, they show back up, right? So historically, about 10, 11% of all the rounds on Carta are down rounds. Last year, it was more like 20. I'm hopeful that 25 will see that number decrease back to more historical averages, but this is a perfect example of dealing with the hangover of 2021.
And it's hard to not imagine this going back to historical norms this year, because if you haven't raised any more money or have already done a bridge, and it's 3 years now, soon to be 4 years after 2021.
Yeah.
It's hard to convince investors even to do a down, like it's either you're a going concern or not. But there still will be cases. There are always exceptions, but there just won't be as many.
Yeah, there's like a decay factor there where it's like, well, if this has been stale for 4 years, like, yeah, convincing the next investor to put money up is really tough.
Yeah, absolutely. Now we're going to move on to talking about co-founders, exits teams, how much equity founders have, that kind of stuff. I think this is actually a really interesting part of the conversation for founders, and some of the data I'm excited that you guys are putting out in public, because a founder will come to me and they say, hey, Rex, like, how much should I give to my first hires?
Yep.
How much equity should I give up at the pre-seed?
Yep.
How much of my company will I own when I IPO? And I used to have companies like, oh, it's roughly this. And now I can just be like, here's the answer.
Love it.
Based on 9,000, here we have 14,911 startups, right? Like, it's pretty good. So let's talk just about the first thing, founder ownership. How much of companies do founders tend to own at various stages?
I think that I think there's a couple things you hear around venture that are actually not usually true, or at least more nuanced, which is founding teams should maintain control until after the Series A round, right? I want to own 50% or more of my business after Series A. Our data shows that's actually pretty rare. The 75th percentile is around 48, 50%, but the median founding team combined owns about 36, 37% of a company after Series A. What's interesting is that doesn't mean that that investors own the rest, because it doesn't look at the employee option pool. So when you add up option pool plus founder ownership, then you get right at that 50% at the Series A mark.
Yep. And I don't have a chart in there on that, but yeah, it's super helpful. Like, well, how big should my option pool be?
Yes.
We have that data, you can find it.
Exactly.
And then how does that change over time between rounds? You can also find that in the Carta data.
Yep.
But if founders are also wondering like where ownerships tend to own up, I thought this was an interesting chart. Just like, also, once you go to IPO, it could vary dramatically.
It's wild. I mean, there are companies, those top bubbles, Atlassian, ZoomInfo, and then a recent one in Klaviyo owning more than half of the company on the day of IPO, which is pretty wild. And then there's DocuSign the founders owned 2%, right?
Yeah.
I don't know if the DocuSign founders were pissed that day. I think they were probably pretty happy about being deca millionaires, but it's still, it's like a different way of building. So
and there's a new trend that's happening now too, of solo founders, I think is one trend.
Yeah, solo founders, I mean, you would know this as well as I do. There's this kind of latent part around Silicon Valley, which is probably you should have a co-founder, right? Like, this is going to be a really difficult journey.
YC in particular is like, you should really have a co-founder.
Very big proponents of it. And I think for reasonable reasons. One, as an investor, it's insurance for you.
Yep.
And two, there is this complementary skill set thing. It's kind of rare to find someone who can do both commercial and product and vision and the whole thing. Yeah. So we're seeing more founders actually. Solo founded startups have increased basically year over year. But interestingly, the percentage, and I think this was another chart on bootstrapping, the percentage that were actually funded by VCs that are solo founders, kind of flat.
Yeah.
So really interesting, like the AI age is empowering more people to start companies.
Yeah, and I think that's actually the more interesting story, which we'll get to. But here, in the last 10 years, it went from one founders being 17% of companies to one founder being 36%. So that's pretty big.
It's a massive shift. Yeah, for sure. And I like that speaks to the idea of how easy is it to start a tech business? Like, versus 2015, I think significantly easier.
Yeah, it's a lot. You can use Carta for your cap table. You can use Mercury or someone else for banking. There are all these tools. And then you can go out and you can Google and get answers to a lot of questions.
How do I raise capital, right? Like all that stuff.
Yeah. And this is actually one of, I think, the most interesting trends that you and I are both excited to talk about. Yeah. You just debunked one myth, which was founders own 50% of their company at the A. That's not true. Yeah. But there's actually a new thing that's kind of the opposite of that, which is there are more founders owning more of their company than ever. So like, what are we seeing
this
here?
Is, I think, just the beginning, or it's the first inklings I'm seeing of like how AI is impacting that company creation point. So the black line in this chart is the percentage of solo founded companies that choose to bootstrap, at least on Carta. And yeah, there's probably a lot of bootstrapping companies.
So a company has one founder and they're not taking any money.
They're not taking any money. Or perhaps they went to raise money and no one gave them any.
That's possible.
That's also definitely possible. But that percentage just continues to climb of solo founders building stuff on their own, or perhaps with a team, but not with another founder.
Yeah.
But the VCs are fairly reticent, or at least kind of not even close to the same growth rate of funding those solo founded companies. So solo bootstrappers, I think, is like an AI age phenomenon for sure.
Yeah, and there are a lot of different interesting threads to pull on here.
Yeah.
I think one of them is we have a lot of concern like, oh, all of the growth is happening in private markets, not in public markets, so the public doesn't get to participate.
Yeah.
Well, now you have this new trend where even in the private markets, you have a lot of companies getting started that no one other than the founder is investing in.
It is really interesting. I mean, if you like push those trends about AI to the logical extremes, like, is everyone going to need to be a business owner in 10 years? And then, how will investors be able to profit? Investors retail or investors private would be able to like share in some of that success. Kind of up in the air.
And the toy narrative you'll hear investors throw around sometimes is you'll have a $1 billion company with one person who runs the whole thing, and the rest is just AI and tools they've built.
That's right. The Sam Altman paradox, or a hypothesis.
Yeah, and it's not that that's like happening, but something closer to that is happening more often.
Smaller teams building really quickly is definitely the name of the game.
Yeah, and then there's also this trend of seed strapping too, which is related to this. Maybe talk about what seed strapping
I think this was from, I read it first from Natasha Mascarenas at The Information, which is founders who are explicitly going out to investors and saying, I'd like to raise a seed round and nothing else. So like, what is that? 3 million of capital or so. And then I'm going to see how far I can get on that 3 million. And my goal is not to raise again. Super interesting. There's some VCs who have been kind of into that model for a while. I think of Bryce Roberts at Indy for one, but I think it's getting more play.
Yeah.
Really early to see like, how do those companies actually do? But less of a binary between
and some founders are doing this intentionally. I think other ones, they raise the money, they get pretty close or at profitability and are growing fast, and they're like, why would I raise another round?
And that's probably paradoxically when their inboxes are full of VCs asking, hey, what do you think about raising some more capital?
And this is what an interesting tension in the market right now is. It's never been easier to build a tech company with less cash and generate more momentum fast. Not easy, but easier.
Right.
But we actually have more venture capital in the ecosystem than ever before.
Right.
And so like what happens?
Yep. I don't know. I mean, I guess it comes down to the persuasiveness of the VCs, you know? So that's on your plate.
It is fun. Well, I'm a pre-seed and seed founder. So if you're a seed strapping founder, this is okay. I'm kind of agnostic of that trend. It's more the much larger firms who deploy at the A and continue to deploy in successive rounds. It's like, well, there might be categories of companies they won't be able to invest in. And
I think this does, when you think about it from the investor lens on seed strapping in particular, it does mean if you are going to pursue that route as an investor, you'll by definition have less to tell your LPs about that company. Yeah. Like, yes, you can talk to them about the revenues, but you won't have a markup in 2 years that you can say, hey, LPs, look at how great, Andreessen came in at the A, look how wonderful that is, because there won't be an A. So it's a different sort of proposition.
Yeah, it is funny. Venture investors are judged primarily on what you just said, which is markup, which is you invest at one price, someone invests at a higher price.
Yep.
Now, a company could grow a ton of revenue, but no one else invests. And it's hard for the venture firm to say like to their investors, this is how much it's worth.
Right, exactly.
Prices are determined in a bidding process.
So it's about like, how good are your relationships with your LPs is really what it comes down to.
Yeah, so this is going to be such an interesting trend to follow in venture. And I think for founders, it's interesting too. You had another great chart showing that solo founders tend to make more money, even if outcomes are smaller. Larger founder teams have bigger outcomes, but they divide up the pie more.
For sure, sure. It's just a question of, whenever we speak to really early founders, we always say like the single most important decision you'll make in your business is who are you building it with in that founding team. Not only because you'll be married to those people effectively for at least a decade, but because it dramatically impacts your ownership and everything else. So
that's a great segue. Or will you be married to them for a decade?
Oh,
and this is another interesting point. So what is this?
Well said. So this chart is showing the percentage of companies based on the year that they were founded that lost a co-founder over time. Not a fun experience. Nobody loves to chat about it, but we see that, about a quarter or so of companies by year 4 will have lost a co-founder in 2 founder teams. So the number one takeaway from this for me is even if you don't love it, like all of you should have a vesting schedule as a founder. It's not good to just grant the equity outright and then the person walks away with 50% of your business and you go, oh, wow, I'm no longer venture fundable because I lost my co-founder.
Yeah. Yeah. And so this is something that's just interesting to see, because if you're a founder and you lost your co-founder, that's usually not something that you hear other companies broadcasting to the world.
For sure.
It's this hard thing. You feel alone. So it's just helpful to know that it does happen.
Yeah.
And this does relate to, I think, a really important company building point, which is a little bit controversial, which is about founder vesting schedules. So what is a founding investor schedule and why is there a little bit of controversy here?
I think so definitions first. The vesting schedule is simply the time frame in which these shares will be granted to either the employee or, in this case, the founder.
Employees have the same thing. So
exactly. So the standard employee one in tech is 4 years with a 1-year cliff, meaning I work for a year and then I get 25% of my equity grant, and then every quarter, every month, I'm getting a little bit more up to that 4-year mark where I'm fully vested. Founders should be on definitely be on a similar schedule in that.
And the standard there is also typically?
It's typically 4 years. We're seeing it, so this is the controversial point. We're seeing it edge out a little bit longer to 5, maybe even 6, but there are folks in the ecosystem who say, that, hey, founders up front should be committing to an 8-year vesting schedule because private companies are staying private longer. So it's going to be a huge build. I can totally understand why founders hear that and say, shut up, VCs, like, this is my company.
Yeah, this is my company, and you're going to make me earn my shares over 8 years. Right. So it sounds like a very founder-unfriendly thing. True. But then what's the pushback?
Well, the pushback is, if you take those co-founder leave percentages seriously, you're actually protecting yourself with a longer vesting schedule than just the investor. I think reasonable people can disagree about what the right time frame is here, but we also are hearing companies that are having to revest some of those shares in negotiations with VCs as they come up to a funding round. Maybe that accomplishes the same goal anyways, and then the founders don't have to start at 8 years. I don't know.
Yeah, and just to give a scenario, a lot of founders, when they hear like, oh, I should be vested longer, they say, absolutely no. But I talk to founders who have lost co-founders and they're like, oh my God.
I wish I had.
I wish I had a longer vesting schedule. Clear how it plays out. It's at the Series A, you still own about 50% of the company, although as you pointed out, that's not actually that common, but you own about 50% of it. Your co-founder is now 3 years vested, owns 75% of their grant, so they own most of their like 25% of the company. And then they leave. And all of a sudden you've got about 20% of dead weight on the cap table. And that's when you're like, oh my God, I am going to stay here for another 4 years. 8-year schedule makes no difference to me.
Right.
But I have this 20%. And so those founders are the ones who are like, oh, actually I understand why this isn't just an investor thing. So this is why there's the tension though, is because they have these two sides of it. And you'll hear founders come down like very hard.
And I get it. Like, I totally understand their viewpoint on it. But the last point is, getting that dead equity back through legal means or whatever, or buying it back from that co-founder, probably, let's be honest, if they're leaving the company, it's not always the case they're leaving on the best terms. That is like a lot of headaches and pain and like everything. So co-founders leaving is a huge disruption.
It's a disruption. And I think even if people don't align on what is the right answer, I think people need to understand the trade-offs.
Yes.
And a lot of founders, especially first-time founders, or even second-time founders who've never been through a breakup, don't understand the trade-off. And so understand the trade-off.
Don't just make these choices without talking about it, is basically what it comes down to.
And it's not just a thing that benefits investors. It does definitely benefit investors as well. So I'm glad we covered that. And then let's talk about, this is another good chart too. It's a very simple chart. It's a simple takeaway, but sometimes founders come to me and they say, hey, I've got this amazing advisor. How much equity should I give them? And there used to be no data, right? And so what is the data on, if you have a great advisor, how much equity should you give them?
So the median advisor grant for pre-seed companies, so you haven't raised price rounds effectively, is 1/4%, 0.25%, which advisors probably hear that and go, well, that's not very much of the company. But
keep in mind, a first hire who's working full-time at a company, how much do they get on average?
1.5. So it's really like, advisor, you don't receive that much equity, but you're not a full-time employee right here. So,
and the whole employee option pool is like maybe 15% at this point.
Exactly, maybe even less. So it can sound small, but it might be worthwhile. The way that we usually couch this is we talk to founders all the time. There aren't that many of them who say, I wish I had given that advisor more equity. And I'm sure that there are advisors that are worth 1% or more of the business. They exist. Probably they exist more in super technical fields where that sort of expertise is at a premium. But in general, if someone's asking for 1% of your business or more, if they're just an advisor, you got to question whether or not that's worth the equity.
And I would also say if an advisor is asking for 1% of the business, they're probably a bad advisor because most people are doing it because they love what they do. They love working with smart people and they understand that's not the right ask.
Right.
And so it's a negative signal if people are asking for too much.
And one of the interesting points about this is we have seen these numbers converge across the country where it used to be that Silicon Valley advisors were actually on median paid less in equity because they kind of understood the game. And advisors in other places were perhaps demanding more and with a less educated founder pool. Those have sort of converged nationwide.
And that's been great. And it's great to have your data out there because, you might get a company coming out of not Silicon Valley where the lead investor took way too much of the cap table at preferential terms. And then there's some advisor who's done nothing who owns 4% of the company. You're like, why?
You're like, this is a great business, but the cap table is screwed up, right? So those are difficult conversations.
And so that's when having this data makes the cap tables and a lot of other things, less likely to get screwed up. Okay, so we talked about founder ownership. We talked about founder vesting schedules, that sort of thing. Employee stock option pools and how those have been trending over time based on the latest data.
I think that it's, typically you hear eventually companies are going to reserve 20% of their equity for employees. And our data actually matches up to that quite well at the late stage. So founders do not need to start with a 20% equity pool. You can start at 10, you could start at 12, whatever it is. And then as you fundraise, it's going to be a consistent conversation between you and the VCs as how much more equity do we need to add to the pool so that we have enough to get the perfect people into the business.
And being a solo founder is hard in a lot of ways. But one advantage you get is you can make a larger employee options pool, right? Because there's just more to go around and you can potentially recruit really high quality people as a result.
And that's always the balance is how much equity is it going to take to recruit that perfect person? You're never entirely sure, so you want to give yourself a little bit of a buffer there, but it's a conversation you're not going to have just once.
And you guys break down this data by sector because it actually does vary in fields that have varying degrees of technical complexity. I would say roughly more technically complex, bigger.
That's the general
option pools, but there are exceptions.
Hardware a little bit more, biotech a little bit more.
As those biotech standing out in one of your
as those skill sets get more, a lower percentage of the population has those really technical skills. So obviously, the premiums are a little higher.
And then this is also just more data on employee. It's just good to know that this data is out there. How much do I get my first 5?
This is first equity for the first 5 hires. I think the main thing that this data shows me when we look at it on an aggregate basis is that first hire is just all over the place. I mean, which kind of makes sense. Especially if you're a first-time founder, it's the first time that you're doing this probably. And that person, you almost certainly have a pre-existing relationship with them of some kind. You're going to come in and they're betting this part of their career on this tiny startup.
If you're a solo founder, they might practically be a co-founder, which probably explains the 6%. Grants at the 90th percentile?
100%. So 1.5 is the median, but I'm sure if you talk to all your founder friends, every single one of you will have a different number there.
Yeah. And I think it's good. There should be more ways of starting a company that have different ways of allocating equity to early employees or co-founders. Because it used to be 2 main founders and then the next person gets a point. But sometimes people should get more than a point,
100%,
right?
Not
all the time.
It comes back into the conversation about titles. How much does this person that you're hiring, how much do they care about an honorary or what is founding engineer or co-founder titles? It can sometimes, one thing we do, I think some founders get tripped up on is it can feel kind of easy to give out big titles at the beginning, but then this person is CTO, but they're really just a founding engineer. And then you're gonna, you're 2 years in and you're like, well, we need to layer in a real CTO here. And then that's a tricky conversation.
Great thing is to not inflate titles at all, but also you'll see a lot of head of, which has this good ambiguity, but you don't want to grant the C-suite title.
As a head of myself, I love it.
Oh, that's right. Soon you'll be chief insights officer.
That's the idea, if Henry's listening.
And then, I guess just a question on structure of how most rounds are being raised these days at early stage.
The safe has just kind of transformed the earliest part of fundraising since it came out. We see nearly 90% of companies using safes for those first initial capital. So if you're not familiar with it, definitely an instrument that you should be familiar with.
Yeah, I think for people listening, it's probably even the opposite. They're like, of course this is how it happens. And they don't even realize that not that long ago, 3 or 4 years ago, only 50% of the time were rounds. I would say for me personally, at the pre-seed, 95% of what I do is on safes. So they've kind of won, but we've almost forgotten how recent of a transition.
And it makes total sense. I mean, even between that and the convertible note, what are you really getting with a convertible note that you don't have on a safe other than an interest rate that's almost certainly not going to be paid out? Like, I guess you get a conversation as an investor, right? You have some maturity date where you get to talk to the founder about their lack of progress, but that's about it.
Yeah, standardization matters a lot, and it's been a great instrument to have.
For sure.
And then I think it's also helpful for people raising early rounds to understand, like, what does a usual round look like for me to get it done?
Yeah, so if you're raising about, call it $1 million on a safe, you probably have between 10 or so, 10 to 12 individual safe investors into that. Now, some of that might be one syndicate that has some people behind it, et cetera, but you're not talking about 40 people when you're raising $1 million or 40 individual investors. It's generally a fairly small group of folks, and then that expands as you raise bigger rounds.
Yep, and usually the main person is taking about half of it.
Exactly, so a lead on a safe, especially if you're raising $2-3 million, they're going to take about 50% of the round.
Yeah. And then just another structural point about how these safes are usually written, and what are the two main terms people usually care about?
So valuation cap and discount are sort of the conversion mechanisms for safes. On Carta, we see 9 out of 10 safes have a valuation cap of some kind, and then call it a third or so have a discount. I'm a little surprised that investors don't want to use both. The valuation cap only is the most common by a significant amount. I kind of thought that as the market moved a little bit back towards investors, maybe they would insist on both terms, but it turns out maybe the path of most convenience here is the one that gets chosen.
Yeah, and I would say if you're raising a 5 or a 10 post or 50, like at these lower valuations, you're not expecting the next price round to come in below that. Yeah. Like we're structurally trying to push these companies up and forward, and so that's probably why.
Is the expectation for you that if you invest, say, on a 5 post, the first priced will be double that?
About double.
Okay.
Yeah. And so if you ran some more numbers, you might see that the number of valuation, the cap plus discount increases as the valuation increases, would be my instinct.
That makes sense.
This is more just on popularity of safes.
Yep.
And I guess median dilution for early rounds too.
But this is, I think, an interesting chart just because some slightly less sophisticated founders it kind of feels like safes are free money, right? Because you get this cash and you don't equity, they're not even on the cap table yet. They're just waiting to be on wherever the first price round is. But safes are not free. Safes dilute founders. Post-money safes dilute founders. And so you should model this dilution out so you're just not surprised, especially if you're going to raise multiple rounds on safes. And that dilution from post-money safes, generally speaking, the other investors on a safe that invested maybe at different valuation caps do not suffer from extra safes being placed on. So all of that dilution is taken by the founding team.
Yeah. And so this is really becomes problematic if you're stacking multiple safes, and the conversion mechanics can be a little bit less than obvious, but there are tools. Carta has one that will help you model what this looks like. I think maybe talk to us, you told us what your definition of an AI company is, but early on, like just the discrepancy between AI and not.
I mean, this is just what everyone's seeing all over the place, which is AI companies are raising more cash at higher valuations, at seed, at Series A, at Series B. It's the same story. Now, will those lines, converge a little bit in 25? I think will be interesting to see.
Will everyone just call themselves an AI company?
That's the thing. It's like how many non-AI companies are really going to be there in 2 years? And maybe not AI native, but are not using AI in some way. I think fewer and fewer.
Absolutely. Seed, same is true at Series B. AI prices going
30, 40, 50%
higher.
Premium. Yeah.
This is one of those slides I was excited to talk a little bit about, which relates to why we're seeing more bridge rounds, why we've seen more down rounds. Walk us through what graduation rates have looked like for companies between rounds historically and today.
Yeah, I think this is a metric that investors focus on more than founders, but it's really useful for founders to get a hold of, which is if you just take a group of startups that raised a seed round, how many of those startups should we expect in a normal year to get to Series A at all? And typically it's, call it 40 to 45%. That's actually a little higher probably than historical averages, but the question of time really matters here. So there's a difference between getting from seed to A in a year and seed to A in 4 years. That matters a lot for the investor markups, for everything. So we looked at this data and we said, in the boom times, you could get to see, like something like 40% of companies got from seed to Series A in less than 2 years, which is pretty wild.
Yeah, probably, so if you like got a seed round in 2020, boom time hits in 2021, very good likelihood you're raising an A.
Exactly.
You raise a seed in 2022,
only 15% have gotten to Series A in 2 years.
By a third.
And that just means that there are more startups stacked in these places. There's a glut of companies that are all chasing the same investors, looking for the same outs, et cetera. So it just feels like every part of venture has a little bit of a bottleneck right now.
I think the biggest problem was actually recycling of talent when a lot of these big companies, especially later stage, just had a ton of headcount. And that was probably the scarcer resource.
Interesting.
That was really getting soaked up. And this, so I guess I teed myself up with my own question, which is, so we were talking about how those graduation rates went way, way up. And that also led to this effect on hiring. So where are we with hiring in the venture ecosystem right now?
This is the single biggest change over the last 3 years across venture-backed startups, which is they're just not hiring. Not nearly as much as they used to be. And people are still leaving.
And I think this needs more air. We talk so much about dollars raised. I think we need more airtime given to what's happening in the talent ecosystem.
Couldn't agree more. This is super fascinating because there's multiple underlying dynamics. So one, yes, we were hiring like crazy in 21, like net hires, 54,000 people joined Carta companies in a single month in 2022. Net. So net of people who left, still 54K.
And imagine stacked on top of this bar chart, the Mag 7, Facebook, Google, Amazon, also hiring.
100%.
And
just
so
everyone growing massively at the same time. Interest rates change, the vibes drop. We have this steep decline in hiring. And now when you talk to founders, the name of the game is how far can I get with my current team size? How far can I get without adding an extra headcount? And that is just a radical departure from where we were 3 years ago.
That could be Zuck at Meta talking about it and doing reductions. It could be, Sebastian at Klarna, who's talked about how they're reducing the size of their customer service. Or it could be someone who's seed strapping.
Exactly. And it's so everyone at every level is looking to maximize that magic ARR per FTE number. And it points to a really interesting quandary with the ecosystem, which is, will we have reached peak people working at startups in 2022? I understand why companies are doing this. It's capital efficient. It makes a ton of sense. AI, all that stuff. But it also makes me a little sad. Like, I got my start at early stage startups. I hope that people still have the chance to do so. Or if it's just going to be this like relentless focus on capital efficiency.
I think this is actually a bigger societal story, which is there are all these on-ramps in investment banking, in consulting, junior employees at startups, and AI has eaten a lot of those functions. So where do people join the career ladder? So that is scary and not a good thing, and we're gonna have to figure that out. When I look at this chart, what I also think about is, people are like, oh, 2021 is a great time to start a company because you could raise money. And I'm like, but do you know what you spend the money on? People. And you're never gonna be able to outcompete the salaries that Meta can offer.
For sure.
And so if you go to 2022, 2023, it's like, actually, sure, you can't raise as much money, but you can hire people. And now you have AI and all this other sort of stuff. And so it's not just the dollars in venture that matter, it's the talent. And now we also have this amazing tool set in the form of AI.
And you're going to be spending some of that money on compute or other things that perhaps you weren't before. But I agree with you. I think if you're starting a company today, I think you have access to pretty unbelievable talent pool and that are like waiting to join these companies. So
let's see if I can find this real quickly. We had, here we go. This is the chart. And you can see that in the market for compensation for employees. So what's this chart and how does it relate to the fact that the job market is less competitive? So if you're a founder hiring people, you don't have to give them as much equity
so
as
like
you used to.
Effectively, if you look across salaries paid to private company employees, private startup employees, if you were hired in November in 2022 versus you're hired in November or April of 2024, your salary is basically flat. Haven't gone up much, which kind of, definitely there's been a lot of inflation since then. So effectively on purchasing power, you're being paid less. But at least they haven't gone down.
Yep.
Equity package, that same employee hired at those two different times, probably looking at something like a 36% decline in their equity package. And that means, yes, maybe those companies went through down rounds, all that stuff. We strip that out. We're literally saying the number of shares, the percentage ownership has gone down a lot. And that is good for founders in that you can effectively, competitively compensate people at lower rates. Not so good for employees who've lost some equity. But candidly, a lot of employees these days are not as focused on equity because they're like, look, I just want a good salary package.
I've been burned before.
I've been burned.
I wasn't able to exercise my options because the company was doing too well.
Yeah.
But I knew it, so.
And 2021 hit and we were promised these IPOs and we didn't get these IPOs and now that equity isn't worth what I was told it was going to be worth.
Yeah, totally. I think it's also interesting to unpack different sectors that are growing in different ways. And this is maybe surprising to people. I feel like everyone thinks venture is all about SaaS, but where are we actually growing headcount?
Energy and hardware are the two sectors, at least at the beginning of last year, that were still sort of eking out some headcount growth.
Yeah.
The rest of them were basically flat or shrinking, which is, this chart is just how many people leave versus how many people join. So if it's over 1, that means more people joined than left. And if it's under 1, the reverse happened. So we think that this will get better in 25, but it also points to an interesting dilemma if you are a startup employee at a company right now, which is, do I look for a new job, right?
Yeah.
Like if I'm not the most happy, but it's okay, my gig is okay. Am I spending a lot of time trying to find that next thing? Or am I worried that at that next thing, I might get laid off because I just joined and I might stick around at my current thing longer so this company doesn't need to backfill? Like all of that kind of feeds into it.
Yeah. There's just, the talent market is very interesting. And then if you're a founder, I think this is a good chart to look at and understand why one of your biggest jobs is always hiring.
And retention, right? So
yeah, the easiest way to not have to hire is
to retain. Exactly. More startup employees will not see the end of their first 4-year grant than will. 50 to 60% will leave before 4 years, which if you're in startups, you probably already know that because all your friends are bouncing around and all that stuff. Yeah. But it does matter for, hiring and firing and the idea of talent, having those core folks stick around so they can make lasting impacts on the business. Like it's tough to make a incredibly meaningful impact in 18 months, maybe at the earliest stages, but you got to kind of be there and see out some of this stuff. So if there's one thing founders can do to set their companies up is how can I strongly retain my top performers is a big deal.
And certainly I feel like every startup I've ever been at, there's a core team that's been there the whole time. And they just have this institutional knowledge that if it's gone, it's really hard to understand wait, how do we sell this major customer? What was the compromise? Why is this in the code base? Yeah. And if you lose it, you don't get it back.
I can, off the top of my head, rattle off 4 or 5 people here at Carta where I'm there's just a world inside their heads that I need to tap into sometimes because I need the context, Yeah. And it's tough to put that into docs or wherever. It's really hard.
Yeah, absolutely. So retention and hiring are 2 really important things. And then, where is headcount going these days? This probably isn't surprising. It's same as ever. Same as ever.
You hire builders and sellers, engineers and salespeople. I do think there's some whispers out there about needing fewer engineers. Yeah. We haven't seen that yet in terms of who's still getting hired. Obviously, that's on a percentage share basis. So on absolute number, maybe it's gone down. Really interesting to see. I think everyone's new favorite word is Javon's paradox. Is it the case that AI enables we need way more engineers, or do we need far fewer?
Yeah. If you make every engineer more productive, hire more of them, they'll do more things.
And maybe our need for software expands to give all of those engineers more work than they can handle, even at this increased rate. So it kind of just depends.
I'll say on top of this, I have a lot of teams that have remote engineering or outsourced engineering that might even be abroad. You used to have a terrible name, but now you've got teams or founders who've worked with someone in India or Eastern Europe or Latin America for 10 years across 3 companies. They're these are as good as any.
These are amazing people. Yeah, for sure.
San Francisco.
And the arbitrage on cost is pretty nice.
As much.
Yeah.
And so on top of just the AI, there's also the globalization of the talent market for engineering.
I think that's one of the lasting impacts of the pandemic and remote work is not just in country, but founders looking for great talent all over the world.
Yeah, and that's been at least as big of a story, I think, for engineering productivity, especially for really, really early stage companies who don't have a ton of capital to throw at the problem.
Definitely.
I think this maybe engineering being hired as well as AI making people more productive relates to this chart as well.
Yeah, which is just, who's getting hired, senior people, middle managers, or individual contributors.
Yeah.
And our data is pretty consistent across companies of all valuations. There's a focus on hiring individual contributors right now and fewer middle management layer. VPs and above are always kind of going to trundle along near the bottom, but more individual contributors, more people who are doing the building themselves.
Yeah. I think part of this is cultural. You've got like Jensen in a video being like, I have 100 direct reports.
It's going to be fine.
Yeah, it's fine.
Who needs a one-on-one?
Yeah. And then part of it is if tooling makes everyone more efficient, just don't have all this.
I really want someone to do the long form story on like what the weekly 1 to 100 with Jensen is actually like, because I don't know what that looks like.
Yeah, I'm sure you talk to the direct reports. They're like, yeah, definitely working.
100%. Yeah, this is my favorite thing.
Yeah. And maybe this would just be a good little introduction or just consideration for employees. I think that's relevant to founders, but like if you're an employee and you hold options in a company, like what do most employees actually end up doing and how should they think about trade-offs of owning that equity or taking ownership of actual shares?
This may be surprising, but a lot of employees who are granted equity end up owning none of that equity when they leave.
Yeah.
Because they choose to not exercise it, even though it's vested. And those individual exercise decisions are made from personal financial standpoints that make a ton of sense, right?
Yeah.
Maybe it costs a lot of money to exercise and you don't have that
You have a
cash.
strike price, so you actually have to pay money to take ownership of something. And then there's probably a gain. So then you also have to pay taxes on that gain.
Absolutely.
Not always, but often.
Yep.
And you might not get any liquidity for years, or you might get no liquidity ever because the equity value of the company could go zero.
So you're playing this sort of multi-variable game in your head, which is how much does it cost me to exercise? And how sure am I about the prospects of this company?
Yeah.
Because it's not just that I own the shares, it's do I have opportunities for liquidity?
Yeah.
And if it's a Series B company, that could be 8 years down the road. You don't know. And so you're trying to future cast this thing. And at the moment, especially with interest rates going up, et cetera, a lot more employees are saying, no thanks, I'd rather just keep the cash.
And this is a little bit of an esoteric debate where it's a little bit polarizing, similar to the founder equity vesting grants, because there's some people who say, yeah, that's what it is. Don't give people an extended window to exercise after they. What you can do is you can give people an extended window. Then when they leave the company, they actually don't have to exercise the options.
Right. Yep.
But that comes at a cost. Now there's more dilution for everyone who does stay.
Yep.
But you look at this and you say, man, is that what you want as a founder for only 30% of people who work for you at some point to ever own equity?
That post-exercise, post-termination exercise period, that you're talking about is 90 days.
Yeah.
Which is pretty short. I mean, especially if you are not expecting to leave and you get laid off, right?
Yeah.
That is tough. And maybe you weren't saving money and now you're like, can I outlay 5 figures to exercise this equity in a 90-day period? Like maybe that doesn't work for me and my family, even though I believe in the company, even though I worked here for 4 years, whatever it is. So it's tricky. I think on the whole, founders, whether or not they extend the exercise period, I think is a healthy debate. I think that what they should be doing is making sure that these employees understand what is going to happen, because one of the biggest things that's represented underneath this line is lack of education of what equity actually means.
Yeah, I think it's also helpful to just understand what's at stake. Without having good data across the ecosystem, you can't really tell what the trade-off looks like and feels like. So if you're a founder saying, hey, do I have an extended vesting period for myself and my co-founder? Well, how many co-founders typically leave?
Yep.
Should I have an extended exercise window for my employees? Well, what does it look like today?
Yep.
If 100% of people were able to exercise their options, it'd be like, well, no, it doesn't really seem to matter.
Right.
But now you can actually look at this and say, these are the numbers.
Exactly.
What do I want to do?
There's 20% of grants on Carta these days have exercise windows over 90 days.
Yeah.
But the interesting thing about this chart is if you look at this chart, it's really just reflective of layoffs. Yeah. Like that big spike in Q2 2020, that is just founders who are laying people off at the beginning of the pandemic, feeling really bad about it, and saying, we would like to give you longer to exercise because there's amending the grants from ISOs to NSOs.
Yeah.
So in some ways, founders in periods of crisis tend to extend these windows. But when everything's going fine, they go, look, you get 90 days. That's what it is.
Yeah. And there's a little bit of a moment back, and I feel like it was around 2017, where people started doing this a little bit more often. And it seemed like that was going to be a trend.
Yeah.
But it's one of those things that when there's more volatility in the ecosystem, you just kind of stop paying attention to because other things matter more.
And but let's be honest, employee leverage is a little bit lower.
Yeah. All right, now we got everyone's favorite topic, Peter.
Who wins?
Wait, who wins? What city wins at venture?
Yes.
What metro area is where all the dollars are flowing?
Which city has the most popular, good-looking people who work in venture capital? No. Look, I think the story that sometimes gets promulgated on X that Silicon Valley is somehow losing its primacy here it's just not true.
Yeah.
We see the Bay especially maintaining a strong lead in all things startups, whether you're looking at early stage in this chart where we see about 35% of all the capital raised went to Bay Area companies. Late stage, it's actually higher.
Yeah.
Because, hey, there's a lot more big late stage companies in the Bay.
Yeah. So Bay Area, number one overall, if I'm getting this chart right, 35% versus next is New York, 12%. So
big
just
gap.
A lot bigger than even number two.
100%.
And across all categories, except there is a good notable call out there for New York.
Congrats, New York, number one in fintech. Well done.
In 2024, we'll see about,
That's right. We don't want to give them the ribbon too early. The interesting part for me here is that Boston, to me, is the quiet up-and-comer in venture. I don't think they get quite as much shine or talked about as the other ecosystems, but they started as, we're just biotech. And that's what we do. And now they're pretty broad-based in health tech and other places. So Boston, well done.
Yep. And Paul Graham started in Cambridge.
There you go.
Before coming here for
there's a lot of talent coming out of those universities.
Yeah. So this is definitely... Any other trends to talk about for the other geographies? You called out Boston and biotech is definitely a strong suit.
I think the interesting part about the rest of the top 10 is, number one, those cities are much closer together than the leaders. There's sort of a cutoff there. Maybe LA can get to the Boston level, but really you're talking about 2, 3, 4% of all capital in places like Seattle, Austin, et cetera. The way that we talk about it is it's actually a great time to start a company in a lot of different places in the US. But once you get to Series A, Series B, a lot of those people end up looking towards the Bay or to New York.
Yeah, yeah. And especially if you don't need to hire huge headcounts and hire massive offices, being here in person as the founder is really powerful. Yeah. Even if you don't have a huge amount of headcount. I'd also give a shout out to Austin and LA for a lot of different things, but hardware in particular. Yeah. And aerospace in LA.
The Gundo has really transformed things over there.
Yeah. And then we have, I don't want to, Miami's been great. It was maybe a little overhyped, but we want everyone to be successful. And I also hey, good for Miami. They pushed really hard and they said, we want this to happen.
I kind of love this chart because it's that thing where you dig into a Twitter controversy and you find everybody's right, which is fun, which is, if you look at Miami over the entirety of venture capital, it doesn't show up in the big top 10 or anywhere because there's no big late stage rounds there. But if you look at the very beginning of when companies are building, Miami has definitely shot up the ranks. Yep. As you would expect, young companies starting in Miami, they got to get big enough to raise those big rounds. So shout out to Miami. I think they've done some interesting stuff, even after
crypto. And they said, we want to grow. We want to be successful. And what's frustrating about the Bay Area, we're number one, and people are like, oh, this is terrible. Tech causes problems.
Right. I do give Miami a lot of credit for being very intentional about it, right? They're look, this is something that we as a city want to put a stake in the ground on. And I'm excited to see where they grow from here.
Yeah. So we'll get in fights on Twitter Miami, but we're still rooting for
Sorry, Keith.
Yeah. Oh, this is an interesting one. Probably less relevant for founders, but maybe it's opening up some visibility in the world of venture funds and how they perform, which founders don't always think about, but does matter. Yep. So you have great data on venture funds performance and returns, which used to be really hard to get access to, especially for the earliest stages and the most recent vintages. Yep. But you guys have that.
For sure.
And I think maybe the shocking thing is most venture funds are pretty close to losing money. Which is crazy. So talk us through what this chart looks like.
Yeah, so
it means.
This data is Carta, take a step back. Carta runs the back office, helps do the fund administration for close to 3,000 venture funds in the US. So, and a lot of those people are emerging manager status, funds 1, 2, 3, or 4, and they're less than 100 million in AUM. We do have many, many big funds as well. But the majority of this data is for smaller fund managers who disproportionately, of course, back early stage companies.
Yeah.
So it's kind of, if you're a founder thinking, why does this matter to me? Well, you want a vibrant VC community that's ready to back early stage founders.
Yeah.
So this is the IRR performance. So the, internal rate of return, investment rate of return for over time for these vintages. Obviously, if a vintage just happened, it's very difficult to have big IRRs because they're waiting for those markups.
Yeah.
Whereas somebody like 2017 vintage, okay, you're starting to see some differential in performance. But you made a good point. Like, none of these numbers are that inspiring.
Yeah, especially at the median. And there are two things. I think one is the dispersion is huge.
Yep.
So that's one of the most important things to understand about venture as an asset class is, hedge funds, we're talking about like the best ones are doing 50 bips better.
Right.
Here, the best ones are doing 30,000 bips better.
Yeah, it's a totally different, power law in all things, right? In startup outcomes and then obviously in fund performance. Like venture works incredibly well if you're in the right 3 to 5% of funds.
Yeah.
But if you take the median return of a venture fund, you probably wish you put your money in the S&P.
Yeah, and this is all locked up in a liquid, and this is why the exits matter, and we're kind of in this weird, thing where venture fund performance hasn't been good. And this is another chart which shows those same kind of return numbers by
And this is,
vintage.
you see the traditional classic J curve of a venture fund where you put in money to companies, they haven't been marked up, so that's negative performance at start. And then as they get marked up, you get back into positive territory. And all of those lines, no matter what vintage you're looking at, experience this rapid growth because of 2021.
Yeah.
And then they've all seen this decline since then. So what this chart shows me is whatever was happening to venture-backed companies shows up in fund returns.
Yeah.
Maybe at a lag, but it always shows up.
Yeah, and when people are like, talking about what's going to happen in venture, you can see how in 2021, things were going really, really well.
Yeah.
IRRs were looking pretty good. Ton of money came in. Now they don't look good. So we're at this kind of reckoning and no one knows exactly what the new world is going to look like. The big guys are still raising tons of capital.
Yeah.
But having the median return sub 15% is not why people are doing venture.
No, that's not an exciting return for most LPs.
Yeah.
That's not what they were looking for.
Where are the most exciting returns usually?
I mean, traditionally, I think that our data shows this a little bit. Smaller funds tend to have both wider dispersion in outcomes, but higher at the high end. So everyone knows it's a lot harder to do 10x on $1 billion than it is to do 10x on 50 million.
Yeah. Yep, absolutely. And so this is where, I'm an emerging manager, there are other people with small funds, and so it'll be interesting to see how we build an ecosystem of big funds and small funds, but there's structural reasons it's hard for people to write smaller checks. It sounds crazy, but most of the investors in funds write huge checks and don't even know how to deploy into smaller funds.
I mean, it makes sense, right? If you're a sovereign wealth fund and you're looking to deploy $3 billion, writing 100K checks doesn't work. You don't. There's not enough people to write 100K checks.
Or even $1 million,
and you're not diligencing all those funds so that they can be 0.0001% of your portfolio.
Yeah, and this gets back to
the idea of DPI here, which is just, look, if you are a venture LP and you were expecting to get money back out of a venture fund after 3 years, you just don't understand the asset class very well. However, at each successive point along the way, more recent vintages have given less money back than earlier vintages. And that's true basically over the past, call it 8 years. Will they catch up? I'm sure there will be really strong outperforming funds in every one of these vintages, but the general air around venture does matter for these funds.
Yeah, and liquidity matters because if you want to, you've invested in one fund and then you want to invest in the next fund from the same manager or a new fund from a new manager, but no money's come back, it starts to stack up and create.
And I think people sometimes think, especially if you're a founder and you're not really giving this too much thought, you're like, oh, of course, venture funds, they get all these money from incredibly wealthy people and other institutions. So it doesn't really matter. They have enough money to keep investing. For high net worth individuals or for family offices or for a lot of people, LPs into funds, that's not true.
Yeah.
You have to get recycled capital back to make those future investments in funds, or else the math doesn't math.
Yeah, it doesn't work out. And this is more of how much money is coming out by years, and it's basically
by tiers.
Not as much.
Are you going to make your money back? How many funds are 1x plus? That's not an encouraging number so far.
Yeah. So yeah, if you invested in a fund in 2017, there's a 10% chance you got your money back. Now you still have money to work in the fund. You might get more over time.
For sure.
But that's 90th percentile to get 1x back in cash. So that's just, I think, a good frame that most founders and folks in the whole venture ecosystem who might be employees or founders or just don't necessarily reflect on. That's interesting to know.
We do typically spend a little less time thinking about the wonderful investors,
Yeah.
You guys deserve some thought too.
People are too busy changing the world, Cool. Well, Austin, this has been a super fun conversation, covered a lot of ground here. I feel like we could go on for hours.
This is great, Rex. I appreciate the time, man.
Yeah. Sum it up for us. I think, what were the big things we hit on really?
To be honest, I think the single biggest thing is how the radical change in how founders are building their companies with talent. And just how much, the constant question of how much talent do I need to build this business? And then pursuant to that, how much cash do I need to build this business? That's the biggest shift over the last few years. And it's, at the one hand, exciting that people are doing so much with such small teams. On the other hand, it presents questions about employees, obviously, but also venture. And saying like, what are these big venture funds going to do if companies can get super, super big with $10 million?
Yeah. So I think 2024 is, there's some good things, there's some bad things, there's some mixed things. In 2025, we're seeing more bootstrap founders, we're seeing more capital efficiency, but we've also seen venture folks raise more money than ever before.
Yep.
So what happens when capital efficiency comes together with capital abundance?
Whatever's the opposite of a fast-moving train and an immovable object, like these things will just pass in the night. I don't know where that money's going to go.
And do we get IPOs in 25? Like there are all these interesting.
Oh man, we need some IPOs. If any of the late-stage founders that we love and adore are listening, IPO is a great route and you should consider it.
Yeah. Well, I look forward to packing the 2025 data and see what it looks like a year from now.
We'll see you next year, Rex. That sounds great.
Sounds good. Cheers.
Cool, man.